Welcome back, A-Luxers. Anytime you think about borrowing money for business or personal reasons, it's important to remember that taking a loan is a serious commitment. Once you've signed on the dotted line, you've agreed to pay back the sum you've borrowed plus interest within a certain time frame. Not being able to make the repayments gets a lot of people into all kinds of trouble. This includes extra fees for paying late, sinking further into debt as you take on more loans to cover the repayments, and a red mark next to your name in the form of bad credit ratings. We've made this video to help you steer clear of this kind of situation. Welcome to alux.com. The place where future billionaires come to get inspired. If you're not subscribed yet, you're missing out. Stick with us until the end and you'll be better prepared to avoid debt nightmares. And you'll even pick up a tip that could mean not going into debt in the first place. Let's get started. Number 1. Do you really need it? Nowadays, it's common for people to ask their banks for loans so they can go on expensive vacations. And yes, loans like these do get approved, but you've got to ask yourself, is it really a good idea? A less costly vacation can still leave you with great memories, but without the loan repayments hanging over your head. Taking a loan doesn't have to be the absolute last resort, but there are often other better options out there. First, ask yourself, whatever you want to use the money for, is the loan really necessary? Can you go for something less expensive that you have the money for? Or just wait until you've saved up the money you need? If we're talking about a business loan for a well-thought-out business plan, it'll often make sense because the loan will help you earn the money. But before you sign for a business loan, do look into other options. Have you ever thought about crowdfunding or looked into what government grants are available for small businesses? You could also try accelerator programs that can help you find different types of funding for bright ideas. Number 2. What kind of lender is best for you? When it comes to choosing what loan to take, be aware of all the types of loans that are available to you and the different types of lenders. Some of them are a lot more reputable than others, and some are to be avoided at all costs. For personal loans, you can approach your bank or you can look to online marketplaces for accredited lenders, and this can also be a good option. On the riskier side, there are lenders who deal in payday loans, short-term loans for when you need a quick financial fix that will cover your behind until payday. But be careful because they come with high interest rates, and to be avoided at all costs are loan sharks. These lenders are usually operating illegally and aren't regulated by financial authorities. They focus on vulnerable, low-income borrowers who they charge sky-high interest rates. If you can't make the repayments, they'll pressure you into taking more debt with even higher interest, and then they'll even threaten or attack you. You can often recognize loan sharks from the fact they have very little paperwork. Yes, we know reading contracts isn't exactly fun, but not having any paperwork for loans is definitely a bad sign. In no circumstances should you accept a loan from a loan shark. Check out the credentials of any lender and be sure they're recognized by the financial authorities in your country. Number 3. What are the hidden costs? Nobody wants to make a deal only to realize later they're losing money for reasons they never even knew about, all because they didn't read the fine print. This is definitely true when you're taking on a loan. Besides the sum you borrowed and the interest, there are usually other fees involved. And if you don't go through all the paperwork, they can escape your attention. They can have names like origination fees, appraisal fees, underwriting fees, or administration fees. Essentially, these cover the costs of setting the loan up. If you forget to make a repayment or don't have the money in the bank when the payment is supposed to go through, you could get hit by late payment fees or a failed payment fee. And what if you pay back the loan earlier than originally agreed upon? You'd probably expect a pat on the back, right? Well, not according to some lenders, who will bill you something called a prepayment fee. They sometimes write this into your contract to make sure they receive all the interest they were expecting in case you pay it off early. Check out the fine print in detail and understand exactly what each of these fees mean. Number 4. Can you really afford it? So you've had a look at how much to pay back every month and how much you earn, and it doesn't seem like too much of a stretch. Well, maybe you need to look into more detail. Never sign on the dotted line before you've made a personal budget and figured out how your repayments fit into it. First, look at your spending habits for every month. What you're spending on basic needs, rent, groceries, utilities, what you're spending on things you like, entertainment, vacations, and non-essential shopping, and then work out what you've got left after that. If the amount you've got left covers your loan repayments, you're in the clear. If not, you might be able to cut down on your non-essential spending, but you might decide you don't want to and that it's best not to take the loan. Remember, a lot of people who fall behind on loan repayments get into trouble because they forgot to check their budget carefully. Make sure this isn't you. Number 5. How fast can you pay it off? Having loan repayments hanging over your head for a long time can ruin your efforts to build long-term wealth. In business terms, it's known as a liability, something that loses you money. What you're looking for in the long term is the opposite, an asset, or things which make you money, like dividends from shares or rent you bring in from property that you own. So think carefully about how long you'll have the debt hanging around your neck. The loan will last for a period of time that's specified in the contract, but see if you can find ways to pay it off earlier and focus on things that will make you money in the long term, not lose it. Number 6. Does it come with collateral? Some loans require collateral and others don't, and the better your credit rating, the less likely you'll need to secure your loan with assets like your house, your car, or other valuables you own. And if it doesn't involve collateral, you'll want to ask, what will happen if I can't pay it off? Losing your car might be a risk you're okay with, but what about your house? Probably not. This depends on you and your situation, but when there's collateral involved, at least ask yourself this question. Number 7. What's the worst case scenario if you can't pay it off? So you've got a plan to pay it off, you've done your calculations and checked your budget and everything seems in order, but what if the unexpected happens and you lose your income? Do you have a backup, like savings, or a supportive family member who has the funds and will be happy to come to the rescue? Make sure you discuss this with them before counting on them and accept it if they say no. Also, run every possible scenario through your head and then ask yourself if you can accept the consequences if you can't pay it back. And if the answer is no, you might want to think again about taking the loan in the first place. Number 8. How will your credit rating come into play? Your credit rating is a score you're given as a mark of how creditworthy you are. Different countries use different credit systems, but they all have a few things in common. Namely, the better you are at making repayments on previous debts, credit card bills, and in some cases even utilities and rent payments, the better the deal you'll get when asking for a loan. A bad credit rating means waving bye-bye to low interest rates and good deals on loans, and some lenders won't even offer you one at all. That's the reason why people with really bad credit scores sometimes resort to loan sharks. So always protect your credit rating. Make the minimum payments for any debts you have, including credit cards, and make them on time. Before asking for a loan, you should always check your credit rating. In most countries, you can ask the country's credit bureau. Number 9. Will it help you make money? So you're thinking of getting an auto loan for a car you can't afford just because you want to show it off around town. Welcome to the club of late players with bad credit ratings and spiraling debts. Or maybe you're getting an auto loan that's going to help you make money through ride sharing. Now that's a lot smarter. So are loans to buy equipment you need for work or getting a mortgage on a house that you'll be renting out. But it doesn't mean you can go crazy with the amounts you borrow. You still need to make a business plan. Calculate what your monthly repayments will add up to and run some calculations of the money that the loan will help you make. If it will help you to make a profit, then it makes good business sense to take the loan. Number 10. What's the APR and the TAR and who's offering the best? If you're not crazy about boring acronyms or complicated calculations, join the club, neither are we. But let's be honest, if you're thinking of taking a loan, you can't avoid them. So keep these two in mind. The APR is the annual percentage rate, or the amount of interest you'll pay on the loan each year. If you borrow $10,000 at an APR of 5%, that means you'll be paying $500 in interest every year, because that's 5% of $10,000. But remember, that's just the interest. You'll also have to pay back the principal, or the original sum you borrowed. So, if you borrow $10,000 at an APR of 5% over 4 years, your repayments will look like this: $2,500 a year in repayments of the principal or the amount you borrowed, split over 4 years. $500 a year in interest, the cost of borrowing the money. Total payments, $3,000 each year, usually broken into monthly payments. Now you can also work out the full amount you'll have to pay back. In this case, $3,000 over 4 years adds up to $12,000. This figure is called the TAR, or total amount repayable. Always work out the TAR and take it into consideration as well as the APR. Lenders might give you the choice between a lower APR over a longer period or a higher APR over a shorter period. At first glance, the lower APR might look better, but often higher APR paid back over a shorter period of time ends up saving you money. You can work this out by calculating the TAR. And with that, A-Luxers, here we are at the end. We'd love to know, what do you think are the biggest reasons some people get into trouble with loans? Let us know in the comments. And of course, for sticking with us until the end, here's your bonus. Set up an emergency fund and avoid having to take loans in the first place. A-Luxers, we're going to finish here with a few facts and numbers to make you think. Every year, 12 million Americans take high-interest payday loans because of emergencies. On average, they take 8 loans in a year, and the high interest rates mean they sometimes end up paying back 5 times what they originally borrowed. With numbers like that, it's clear they would have been much better off avoiding these loans in the first place. And often they could have avoided them if they'd just been a little smarter with money. And there's a simple way to do this. Build up an emergency fund and avoid taking loans in the first place. Use a budget and stick to it to keep your spending in check, and every month set aside some money. If you can, 20% of your earnings into an emergency fund. Keep on doing this until you've got your basic expenses covered for at least 3 months, or if you can, 6 months is even better. This way, when an emergency strikes, you'll be covered. You won't even have to take a loan, and at the same time, you'll save yourself mounting debt, bad credit rating, and paying up to 5 times the original amount in interest. Thank you for spending some time with us, A-Luxers. Make sure to like and subscribe so you never miss another video. We also handpicked these videos, which we recommend you watch next. You can talk to us on all social medias or ask a question on our website, alux.com. Thank you for being an A-Luxer, and we'll see you back tomorrow.